Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And what's interesting about this is the reason this is very, very important from a global macro standpoint of the dollar. Think of this as dollar going out of the U.S., funding global growth. Think of this as dollar credit shrinking in the world, coming back. The supply of dollars is declining around the globe and coming back to the U.S. So from a pure global macro supply and demand standpoint, as dollar-based credit recedes from around the globe with this arrow going up, and the demand for credit increases. As we know, all the emerging markets are dying for more credit, and everybody else is. As the demand increases and the supply decreases, we think it's going to tend to support the dollar in a very, very big way. And as I said, this whole blue area is the credit crunch area, which has launched this improvement in the U.S. current account, which is in and of itself a function of U.S. consumers saving. This chart is a little bit esoteric, and there's a lot on here, a lot of moving parts, but try and stay with me. There's only, I think, a couple key points you need to understand here. The red line here is the U.S. dollar index, okay? Keep in mind U.S. dollar index. Again, this is where the bear market, the latest bear market, the 7-year bear market we've been in started right around July of 2001, peaked in here. You could say it started maybe in here, but this was where the bear market started in the U.S. in terms of the dollar, and we saw it go down, down, down. Then the credit crunch was right here, and the dollar started back up into a bull market, or at least started to rally here. It's still, the jury's still out whether or not this is the multi-year bull market we think it is. But one of the points I wanted to make here is, as the U.S. dollar is coming down, we see the other asset classes going up. The black line is S&P 500. You could have put any stock market on here, any global stock market, you would have seen the same move. Commodities, same way, up. And commodities in here, we could have broken this commodities line, this blue line, out into gold, oil, whatever you want, black pepper, whatever. They were going up. And to see this type of correlation in these major asset classes, oil, gold, stocks, bonds, all at the same time going up as the dollar is going down, it tells you something. It tells you there's a powerful driver here, and we think the massive amount of liquidity in this cycle, which was the driver, was so overwhelming that this was something that it was very different in this cycle because of those derivatives. Therefore, the break that we've seen because of the credit crunch, the break in liquidity, which has broken these asset classes in a very big way, which happened to correlate exactly when the U.S. dollar bottom, is something that's going to play out over years. This played out over 7 years. This just started. This move in terms of the dollar bottoming and the major asset classes breaking down just started back in early 2008. The dollar bottomed in March of 2008 last year. Pretty much went sideways, went up a bit until July, and then rocketed up in July. Okay, and so it just so happened it correlated almost exactly with the commodities market. If you put a chart of gold and U.S. dollar, gold topped right about the same day the dollar bottomed. So the point I'm trying to make here is the implicit weak dollar policy to fund the globe has changed because of the credit crunch, and the dollar has been launched in the bull market. One point I didn't make, which also is important, one of the reasons we believe that there was an explicit change in the U.S. dollar policy on the government side was precisely because of the credit crunch. The Fed really had to have some raw material to try and provide some confidence in the world. Remember, the U.S. Fed is the de facto central bank for the globe. And what the Fed does really is the driver of everything, even though the other central banks are important. We got to a point here, and the credit crunch was so bad, you remember things were on the cliff, Bear Stearns was falling off to the table, that it no longer made sense for any of the major players around the world to continue to trash the dollar. It was more important to try and bring some modicum of stability into the credit system, or we would all be in trouble. And one of the points that we were watching very, very closely is, and you don't see it on this chart, and I apologize, I don't have this chart on here, but if you pull a chart up of crude oil and the dollar, they were going in lockstep. As the crude oil went up, the dollar went down, 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 down. That changed in March. That changed the day that they saved Bear Stearns, because that's actually the day the dollar bottomed. All of a sudden, we saw crude oil continue to go up, but the dollar went up also with it. And we think that was an implicit change of the major players around the world. The Saudis stopped moving money out of the dollar and started moving money in the dollar to try and stabilize the credit system. Again, just a thought, just a theory. We were watching that closely, and it corresponded. And you may have heard me say this once before, if you've listened to some of the things I've said. It corresponded very, very closely, and something that we think by paying attention to the news, at least the macro news, helps. About a month before the dollar bottomed, Vice President Cheney took a trip to Saudi Arabia. About 2 weeks before the dollar bottomed, President Bush took a trip to Saudi Arabia. And the day the dollar bottomed, or that week after they saved Bear Stearns, we saw Treasury Secretary Paulson just happened to be in Saudi Arabia, and they came out, and the Saudis came out and said they weren't going to de-link from the dollar. They were going to maintain their dollar peg. And to us, that changed the game on the implicit dollar policy, and was one of the reasons we thought the dollar had bottomed right in there, even though we needed more confirmation of it. Okay, export models are history. We definitely think that the export model, which has been part and parcel to this huge boom in the global economy, especially for Asia, and has funded all those surpluses, created all those surpluses, and all those deficits in the West, we think that game is over, again, because of the U.S. consumer. If you remember how this crisis started to develop, one of the things the analysts would tell us is that because of all the massive FX exchange reserves in Asia and in China, and even Germany's very good current account surplus, that these guys were going to skate through very, very nicely, even though the U.S. was in trouble because of the credit crunch. And for a while they did. But all of a sudden, the numbers caught up with it as U.S. consumers stopped buying, and these numbers have plunged. Now they're down in this range, some down 40%, the export growth in the emerging Asian markets, which includes China in here. A massive, massive fall off in global exports and global demand that we really haven't seen before, given the environment. And we were also told during this process that don't worry, China's going to grow at 6 to 8%, and these problems are going to be solved. But this basically really ended this idea, this theory from these emerging market cheerleaders that everybody would decouple from the U.S. We soon learned that major FX reserves were massive surpluses built up in Asia that weren't reinvested in their own economy, that were only recycled back into the U.S. Why is that important? Why is that critical? Well, it's critical because Asian economies are built on the export model. They did not take those massive exchange reserves and put them back into their own economy and build their domestic economy because number one, they just didn't see the opportunity. It was a little risky. Number two, it was easier to maintain this export model because the Asian countries have an implicit and sometimes explicit manipulation of their currencies to keep them weak to drive exports. They have implicit and explicit trade barriers up on Western goods, stuff that gets by the WTO, and therefore it was very easy to ship money, ship stuff to these open markets, keep their markets closed and suppress their currencies. They were doing fine. They didn't really care if their consumer was doing that well. If they did, fine. If not, fine. One of the concerns of some of these despotic or semi-despotic, however you want to term this, emerging market leaders is they like to maintain their political power, and a lot of them have been afraid that if they give too much power in the hands of the consumer, which means building your domestic market in a way that allows your consumer real choice to put his money inside the country or outside, if a lot of them did not do that for political risk. They just kept going along on this export model because it was easy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.